Good morning, everyone. Welcome to this Kepler Trust Intelligence webinar. This week, we're considering thematic investing, looking at some long-term trends which offer the potential to deliver market-beating returns. Shortly, we'll be hearing from Mark Hume, manager of BlackRock Energy and Resources Income, or BERI. BERI invests across traditional energy, the energy transition, and the mining industry, with a unique investment remit locked into lots of interesting themes. The shares currently trade on a discount of around 12% and yield just over 4%. Before handing over to Mark, a reminder, if you're new, that the format is 25 to 30 minutes for the presentation and then 15 minutes or so for questions. And if you could put your questions in the box on the side of your screen, then I'll put them to Mark at the end. So over to you, Mark.
Brilliant, thanks very much, and good morning and welcome to everyone. I really do appreciate your time. Everyone's time is valuable in this modern age. I will try to fly through the slides as quickly as I can. I don't really want to do much of a page turn, just to try and get hopefully to the crux of the matter, but also to get to the questions and answer session as well, which we always look forward to, and we will endeavour to try and answer as many questions as we can. But as I'm sure some or perhaps all of you might be aware, unfortunately we can't comment on specific companies, but we can talk about industries. So if there are questions that are more company specific, unfortunately we'll unlikely be able to give you the right answer. So what's the key overarching message that you should take away today? I think I was thinking about it last night, and actually it's one word, and it's flexibility. It's the flexibility to navigate through the energy transition. I'm sure many of you will have seen lots of forecasts of what the energy transition looks like, but a lot of them are actually normative forecasts or backcasts, so trying to solve typically in many cases for the fastest possible path to the lowest possible carbon outcome. And not that we disagree that that's a possible path, we tend to think that actually the reality will be more nuanced than that, because it's going to be solved, or the energy transition will be solved through three key lenses: decarbonisation, affordability and security. And when we look out to 2050 or even beyond that period, it always seems a little bit wishful thinking to us, frankly, that we can accurately predict what a consumer, say in Delhi or Beijing, is going to fill their car with. It could be a molecule of hydrogen, it could be a molecule of renewable diesel, or it could be filling it up with electrons that are sourced from a solar farm or even a coal plant in the most extreme case. But as one of our favourite forecasters recently opined, it's kind of the will versus should world of forecasting. We know that we should make the world a better place, bad things shouldn't happen to good people, or that we should respect nature. And this is certainly a guiding light for us. But there is the will part, and that's the energy trilemma. And I guess to complicate matters further, at least in the last couple of years anyway, we can also observe an increasing degree of geopolitical fragmentation, whether that's viewed through the lens of Ukraine, Russia, China, US, or the Middle East tensions are very high across the world, and we don't really see any data thus far that would suggest that that's going to abate anytime soon. But through all of the uncertainty, we can make some reasonable forward-looking estimates that are less likely to change. First, we know with reasonable confidence that global population will increase towards 9 to 10 billion people over the next 30 years or so. And the vast majority of that growth, in fact all of it, will come from emerging economies. The second part is that since emerging economies consume considerably less energy than we do in the West, it seems totally reasonable to us that they will strive for access to more energy, not less. And that leads to the simple observation that overall energy demand is very likely to increase in the decades ahead. And in third, an increasing amount of energy will be sourced from electricity. The key, of course, is from which sources and the speed at which that happens. And finally, in order to rebuild the energy system, is going to require a step change in materials and mine commodity production. The important point really is that the pace and the direction of each country's energy transition journey is going to be different. It's going to cause a lot of bottlenecks, not just across energy and power markets, but also across industries that will supply much of the materials, whether it's copper, aluminium, silver, or indeed lithium. Energy-intensive industries, we know, will also be impacted at various points through the journey. Now, after 3 decades of the Chinese demographic dividend that's resulted in falling or deflationary prices for goods across the value chain across the world, we actually think the next 3 decades will be prone to higher inflation and higher inflation risks. And the energy transition will be undoubtedly punctuated with winners and losers. And although we are excited about the advent or prospect of breakthrough technologies, we also see a pretty bright future for a lot of the incumbents. So to pull that together, to navigate through the energy transition, we do think flexibility is going to be key, and that is a key feature of the trust itself. And if we just pop forward onto, I guess, the sort of slide 4 and slide 5 here, just a reminder for those that are not familiar with the trust that part of that flexibility is anchored in our ability to take on gearing and to also invest in fixed interest instruments, as well as option writing, where we see opportunities to lean into stocks that we feel very passionate about over the long term. For those not familiar with the BlackRock Energy and Resources Income Trust, it was launched back in late 2005, and it was largely anchored on the premise that Chinese economic growth would be very energy and materials intensive, and certainly up until the last few years, that was very much the case. But as the world's been shifting towards this multi-decadal transition in the energy system, it was pretty clear that a fresh approach would be required. And with incredible support from our board, my co-portfolio manager, Tom Hall, and I set about pivoting the trust from a pure mining energy focus towards a blend of mining and materials, traditional energy, and energy transition. And in the chart you can see in front of you is just a stacked column chart with the 3 major components of the trust and how that's evolved over time over the last 3 years. And since we've taken the trust in the midst of COVID, in fact, into that new strategy, we've taken the NAV from about 60 pence per share to 123 pence per share as of yesterday's close. And the price over the same period has gone from 52 pence to 108 pence per share. And we've also taken the dividend from 4 pence a share up to a current annualised rate of 4.5 pence per share, as Tom rightly pointed out. That maps to about a 4% dividend yield. And the current shape of the portfolio is shown in the chart above, and it gives a flavour for the sort of types or subsets of industries that we're investing in across the energy transition and mining areas. I won't dwell on that just now because I would like to try to get onto the energy transition itself and really let you know, I guess, why we think the flexibility is so important and why we're so excited about the flexibility within the trust to help navigate clients through that. One of the key things I think to bear in mind is that supply really struggles to match demand. And just to give you a couple of small examples along those lines, we do think demand for electricity is going to increase substantially over the next 30 to 40 years. But if you look at, say, the average age on the demand side for light duty vehicles, whether they be internal combustion engine or ICE vehicles or electric vehicles, the age of that fleet is increasing, and it's gone from about 9.7 years in 2003 to 12.5 years in 2023, i.e. there is a certain inertia in that system to turn over the fleet to sort of fully electrify it over a reasonable period of time. And then when you think about the flip side of that, when we think about permitting and constructing, say, a copper mine, and copper goes into both ICE vehicles and electric vehicles, that process can take about 20 years, from permitting to development to first production. So there's a real mismatch when you think about the ability to go online these days, click a button and you can order a new car within probably 20 minutes. It might take 20 years for the incremental copper to arrive. So that constant mismatch of supply and demand, we think, will throw up a lot of opportunities across all parts of our investment universe for the trust. Now, I have got a slide that I'd like to talk about next, which is a very busy slide, so we'll spend a bit of time on it, but there's so much to unpack, and forgive me for the garish colour system. It's been adopted by BlackRock as our new colouring system. It's mildly offensive to say the least, but hopefully you can discern the different parts of the chart. It's actually a view of the energy transition and the sources of energy that are likely to be used out to 2050. It's not our view, it's a view of a third-party consultant that we do rate very highly, but it's really just to try and illustrate, I guess, some key points within how we think about the world, as opposed to some of those normative scenarios of backcasting that we've talked about before. So what you see in front of you is an independent view on total useful energy supplied from 1800 through to 2050, so 250 years worth of information on that one chart. The first thing to note is the sort of dark purple line that hockey sticks up and to the right. On the right-hand axis, that's the absolute amount of total useful energy, and based on this forecast at least, it's seen rising from about 75,000 terawatt hours in 2019 to about 120,000 terawatt hours in 2050, so very consistent with the rise in population growth, as well as the rise in energy intensity, which we fully expect to happen as emerging economies want to have a higher quality of life. And even within that sort of hockey stick view on the absolute level of energy demand over to 2050, that only sees emerging economies go to from 1/4 to 1/2 of the energy that we use today in the Western world. The shaded areas in the chart show an evolution of the fractional share of useful energy over time. Some of the notable things, of course, you can look at the dark green and the sort of bright pink colours being biomass and animal, and up until the sort of industrial revolution around the middle of the 18th century, they were the sort of dominating drivers of useful energy. We move into the sort of purple, darker purple, and that's coal, the advent of coal, the steam engine, and that played a huge role in driving up useful energy consumption, improving quality of life that we've heard about before. And then we step into the oil age, which started around the beginning of the 20th century and then accelerated with the advent of the internal combustion engine. And then we've got the yellow slug on top of that, which is natural gas. And that's been a bit of a slower evolution for natural gas markets over time, but actually a very important one. And at least in this particular forecaster's view of the world, we think it's quite interesting to observe that the yellow wedge, if you look at it into the forecast period, really expands out. And that's important because when we think about carbon emissions today, we're running at about sort of 50 gigatons per annum of total GHG emissions right now. Now, if you think that if we did nothing to change the current mix of fossil fuels in the energy supply, being the sort of dark purple, light pink and yellow shaded areas, then we would go from sort of 20% population increase, and you'd have a 30% increase in energy intensity over that period. You multiply the two together and you get to a little bit under 80 gigatons of emissions if we did nothing to change the energy system today. But the good news is that actually when you look at this particular forecast, we can get towards a net zero picture by 2050, and part of that is achieved through switching from coal to natural gas, and that sort of gets some 13 gigatons of emissions out of the system. A large part of it, of course, we know that solar, wind, a bit of nuclear, a bit of hydro, will also play an important role in that too, and that will get, the lights have gone, that will take out another 22 gigatons. There's energy efficiency moves, which is part of the energy transition pillar within the trust. We'll get rid of another 20 gigatons, and carbon sequestration about another 7 gigatons. And finally, within all of that, the forecast embeds about 17 gigatons of nature-based solutions. A large part of that is reforestation. For the eagle-eyed amongst you, you might still see that a few of us will still be burning wood in our stoves towards the end of the forecast period. I guess that the point that we find quite informative, though, is this idea that we might actually need fossil fuels for a longer period of time than some of the normative scenarios would suggest, but that doesn't preclude us from actually getting emissions overall down towards that net zero goal in 2050, plus or minus a few years. And that is somewhat antithetical to, I guess, a lot of the views that are held today, but particularly as it relates to natural gas. We think there's a big role for it to play going forward, as there is for solar and wind, who we're also pretty excited about that too. And just on that, that sort of leads into another point that we think is quite important to understand. Within the framework of electricity demand rising over time, we think, or we at least agree with the third-party forecaster, again, the same group that we show here. What you've got on the left-hand side is the absolute additions in gigawatts annually of solar and wind by major region. And then critically on the right-hand side is the amount of penetration into the electric grid system on the right. Now, there is a limit, we think, to how much renewables we can put onto the grid without completely destabilising it, and that, we think, is somewhere around 50%. Now, we do have some battery technology that can help to solve our intermittency in the very short run, but we've yet to find that breakthrough storage technology that will allow us to bridge from seasons rather than hours and minutes. And when we think about the penetration of solar and wind, as well as hydro over the coming years, it's pretty interesting to actually observe how volatility is going to change. And again, this is an important point, we think, of that flexibility of the trust to sort of pivot between the old and the new, the sort of mine commodities, traditional energy, and the energy transition piece. Why do we say that? Well, if you look today at the current penetration of solar and wind, and hydro, it's about sort of 5.5 to 6% total useful energy in the world today. And based on this forecast, we would see that get to 30% of total useful energy rather than just the grid at 50% over time. Now, that's important because the volatility, the variability of solar and wind, when it's not sunny, then there's no solar. When it's not windy, there's no wind. Is somewhere between 3 and 5% per year at the country level. Never mind the asset level, at the country level. Now, when you start to contextualise that and look back at some of the variability that we've observed in the global energy system in recent years, whether it be Ukraine, Russia, Fukushima nuclear event, or whether we look at something like the Arab Spring, those all had 0.5 to 0.7% impacts on the annual energy system and caused outsized doubling, tripling, quadrupling of energy and commodity prices in some cases. And what we're now looking at is the share of renewables grows over time, is a continued increase in volatility in energy prices and very likely power prices. And we can actually see that first-hand happening in the likes of Spain and Finland, where we're observing negative pool prices on some days during the summer, for example. But that also sort of comes back again to this point around the need for flexibility, we think. Because when we did pivot the trust back in 2020, the idea was that we could have gone to 100% energy transition, but as we looked out over the next sort of few decades, we felt very passionately that actually you need a lot of the traditional mined and energy commodities to help make that pivot over towards a lower carbon future. And that's exactly the way that we've framed the portfolio today. I guess it's worth touching on just some of the geopolitical events that we have seen, and the importance of that is that when we think about the Ukraine-Russia situation, where the European Union has pivoted very assertively towards increasing renewables penetration out towards the end of the decade, as well as pivoting across to the US for sort of natural gas supplies. It's turned off its dependency on Russian gas supplies. And what you can see in some of the outlooks now as a result of things like that, policy changes, but also things like the Inflation Reduction Act in America, the two central charts there have been very supportive for the more aggressive, higher acceleration build out in renewables. But as we noted before, it's important to bear in mind that that can and will very likely cause some volatility in power prices and energy markets going forward. I guess the other thing just to be cognizant of, and why we do like the flexibility within the portfolio, is that we had some 2023, to all intents and purposes, at least from a renewables and sort of a decarbonisation perspective, was a spectacular year. And you can see the top right there, the overall installation volume in renewables sort of bounced from 342 to 506 gigawatts. We've seen investments into the sort of semiconductor space in the US, for instance, partly as a result of the CHIPS Act, but also compounded by the Inflation Reduction Act, has gone from a run rate of 10 billion a year to over 100 billion a year in 2 or 3 short years, really pulling on that demand for energy efficient products. And then the bottom right, we can all observe too that electric vehicle plug-in and full electric vehicles sales have inflected up very aggressively in the last 2 or 3 years. But that should be borne against, I was just sort of looking at the numbers this morning, but over the last year or so, we've had, wind stocks. If we look at, say, some of the ETFs that are available out there are down sharply. Hydrogen stocks down 50%, solar stocks down sort of 40% over a 12-month period. And some of the clean energy indices down sort of 25 to 30% over that period too. The point is not that it's a busted flush, but just to observe that just because we've had outsized growth doesn't always relate to or translate to outsized returns. And again, that flexibility we've got in the portfolio to sort of pivot between the different pillars, we think is a really key attribute for investors. I'll maybe just quickly finish off on the traditional energy side, and what you're seeing here is a sort of an extraction of that earlier forecast that I showed, looking at total useful energy and the sources of percentage share of the sources in the coloured shaded areas. This is just looking at that same forecasted view of oil demand, and I guess the point is not to say that it's right or wrong, but to observe that actually in that scenario, their scenario, base case scenario, they still see oil demand running at circa 85 million barrels per day by 2050. 30 million barrels per day or so will come out because of electric vehicle penetration, which the same forecaster has accelerating beyond what we can see in consensus forecast today. So it's not like they're missing a trick there. It's really driven by a belief that there'll be a greater demand for petrochemicals, as we need more and more materials to rebuild more and more of the energy system. Now, I guess that should be contrasted with some of the normative scenarios that might suggest that oil demand is somewhere less than 30 million barrels per day as compared to the 102 million barrels per day that we clocked in for 2023. So just a different view of the world, not necessarily that's exactly what will come to pass, but I guess the context again is that this is still with a path to decarbonisation over the period to 2050. The one for gas, when you actually pull out the absolute numbers, as you can see here, the forecaster has gas running from 4 BCF per day up to 800 BCF per day by 2050, doubling in natural gas consumption over the period. And we still maintain a similar view of the world, that we will very likely require more and not less natural gas, because it is, in our view, one of the most energy efficient ways to maintain and to help renewables sort of build their penetration into the power system over time. And frankly, some of the numbers when we think about the power system are quite staggering. I was looking at the data this morning, and depending on which forecast you want to believe, as we build out the power system over time, investment there might need to rise to sort of $1.5 trillion per year. That's a 5-fold increase on the power grid side, and as much as a 3-fold increase on the power electronic side. So think transformers, or rather poles and wires, and then transformers as some of the examples there. So lots to get after in terms of investment over the course of the year. And then maybe one sort of parting thought on all these forecasts. We had a little bit of a look back, and this was in the annual report for Berry this year, at where did we get surprised last year with a forecast. So every year we sort of take a view of what we think the world's going to do, and at the end of that year we look back and say, well, what surprised us most? What did we get wrong? What can we learn? What was quite interesting is when you look at the forecasts, consensus forecasts at least for oil demand, oil supply last year, the surprise was partly in the United States through continued growth in US shale, but actually it really came down to Russia and Iran. Russia was up about 1 million barrels per day relative to expectations. Everyone thought, including us, candidly, back in the start of last year, that Russian volumes would roll quite heavily through a lack of capital and the sort of maturation, general maturation of their oil hydrocarbon basins. That didn't prove to be the case. What we found is that price does matter, and there were certain countries in Asia, for instance, that were quite happy to avail of heavily discounted Russian crude to put through the refineries. Iran was also a bit of a wild card as well through that period. But actually on the demand side, although there's a lot of puts and takes on the right-hand chart, demand actually came, if you look at the two grey columns on both sides there, the forecast for demand kind of landed about right. Where were we surprised to the upside? China came back stronger than we thought. Russia was actually incredibly resilient despite the ongoing efforts in Ukraine. But really it was the US and Eurozone where demand expectations were slightly weaker than anticipated. But just a flavour of how difficult it is to get these forecasts right on a 1-year basis, far less a 30-year basis. And then if we sort of, I guess, land at the end on valuations, at least for the traditional energy piece, and hopefully we can open up for Q&A in a second, is the valuations actually across most of the investment universe look actually pretty compelling. Whether it's in the traditional energy space, where we're seeing double-digit free cash yields on very reasonable assumptions for the European companies, less favorable for the US companies. We're kind of tilting the portfolio that way a little bit. Equally, when we think about the sort of pullback in some of the cleaner energy stocks, whether it's solar, wind, hydrogen, electric vehicle related stocks, and they've all come back 30, 40, 50% in some cases in terms of stock price, and valuations there are also beginning to look relatively compelling. And I guess that sort of pulls it all together to a sort of parting point on the trust. And the reason we're so excited about it is that we're not investing in tech stocks. So it does offer sort of an alternative to having all your eggs in a technology basket. But perhaps I'll park it there and hand back to Tom.
Brilliant. Thanks very much, Mark. Lots of things to think about there. And we already have a few questions coming in. But if you're in the audience, please do add your questions. We should have plenty of time to get through all of them. So where to start? I guess we looked at your long-term trends in sort of forecast for energy production. There was a very good chart showing how that changed over time. And we had a question on what geographies will be driving the increase in yes, that's exactly that one. What geographies will be driving the increase in gas and solar, and how will they achieve this? And as a related point, who's going to be driving this transition? Is it governments? Is it industry? Which bodies are going to be driving this?
Okay, good questions. So I think at the aggregate level, what we feel and observe today is that, broadly speaking, the US stroke North America has set in motion a set of industrial policies that are super supportive for the energy transition. We can already see capital flowing into the US. The chart that I showed on this one here, that sort of middle chart there, just showing that hockey stick in terms of investment as a direct result of policy changes, but more incentives based rather than sort of penalties, as we often observe, or taxation, as we often observe seen in the European Union when it comes to policy shifts. And I think that sort of brings about one sort of overarching view of the world that we have today. We know where the population growth's coming through. It's Asia, Southeast Asia, Africa, predominantly, a bit of Latin America. And that's where a lot of the growth in gas, natural gas, solar, wind will be. There will be a reasonable amount of growth in renewables, we think, in Europe. But the challenge, I think, when we think about the world and where we might be putting our clients' dollars over the next, or at least for the foreseeable future, is when we think about Europe, we still feel that it's structurally disadvantaged when it comes to the energy transition. Not for lack of trying necessarily, but partly because since the Second World War, Europe has benefited from sort of low stroke no cost defence support from the US. It's benefited from cheap Russian energy imports. It's also benefited from the cheaper labour in China, which has helped to sell ever cheaper goods into Europe. And probably the less sort of talked about element of European policy has been sort of an undervalued currency for many years. Now, all four of those elements are changing right now. Energy prices are higher in Europe than they are in the rest of the world. So that makes, I think, competition very tricky for Europe. We do worry about sort of aggregate demand in Europe when it comes to natural gas, when it comes to solar or wind. Where we think from a regulatory perspective, things could improve in Europe is if we were to see more of a pivot back to nuclear. We've obviously seen the likes of Germany sort of move towards closing down its nuclear plants quite quickly. We've seen other countries in Europe follow the same path. And yet in the US and then in Japan and other parts of Asia, there's definitely been a sort of a renaissance in thinking around the nuclear component of the energy transition. And obviously we've been able to benefit from that in the trust through, directly through upstream uranium producers, but also through power producers that have a nuclear power plant capacity in them. But I think, when we look at the big picture driving forces, the area where we'd be least confident would be Europe. The areas where we'd be most confident would be Asia and the US over time. And certainly there'd be a lot more, despite the pause in LNG project build-out that's been proposed by the Biden administration. We still think the US will be a key supplier of natural gas to the world. And we still think natural gas has a reasonably large, important role, let's say, to play in sort of getting more renewables onto the grid and making them more durable and less volatile.
Yeah, we have a question on specifically coal and oil cheaper compared to wind and renewables, whether that will lead to consumers pushing for a return to cheaper power sources. And I guess, gas could be considered a kind of a middle way, but nonetheless, do you expect there to be growing political pressure? And perhaps I could link to that, just raise the prospect of a potential Trump presidency, which we may see later in the year. Could we see some political pushback against the shift to renewables? Could we see consumers demanding reversing the course?
Ultimately, price does play an important role in consumer preference. I think my sort of compatriot Adam Smith would talk about the invisible hand and incentives. If something's cheaper, the tendency for most human beings is to go for the cheaper option most times. That being said, we do think that coal, oil, yes, cheaper, but I would point to power prices, for instance, having collapsed in the Iberian Peninsula. As a small example, Spain, Portugal, power prices there have gone from an expectation of about €100 per megawatt hour down to about 51, I think, as of yesterday morning. So there's been a complete collapse in those power prices, and that's been driven by a complete collapse in gas prices, natural gas prices, that we've observed in Europe. So actually, it's making sort of the alternatives, if you like, more competitive. What's also helped that fall in natural gas prices, and that plays into its relative competitiveness with coal, is the fall in carbon prices as well, particularly in Europe, where we've seen the ETS fall from nearly 100 to, I think, about 59.60 in the last few weeks. So, when we step back and think about the coal versus natural gas debate, we feel relatively confident there's enough gas out there at a reasonable price, such that it can remain competitive with coal, especially when you think about the sort of attendant carbon price on top of it. But then think about even the sort of the NOx and SOx emissions that you see next to coal plants, and take China as an example. Yes, they still have some capacity build out in coal in the short run, but we think natural gas plays a bigger role because they need a license to operate, and frankly, a smoggy Beijing is not a very popular one. So price matters, but I think that the sort of observable pollution matters as well in the case of coal. And then thinking about oil, the oil prices have remained remarkably pragmatic, for want of a better expression, despite the fact that we're on the cusp of a really serious incident or confrontation in the Middle East, where 30% plus of global supply comes from not just from oil but from natural gas. And we're quite astounded that energy markets have not been more concerned about that of late. But then thinking about, say, electric vehicles, where I think at least the forecast that the third party that we looked at produced on the energy side, when you think about oil, we still see that going down over time. It will peak in the next decade or so, for sure, in our view. A lot of that will be taken away by the electrification of the light-duty vehicle fleet. And frankly, they're better products. We can all sit in an electric vehicle and an ICE vehicle, and they're just nicer products. So, the price of these vehicles, still subsidised, still relatively attractive against ICE vehicles. I think at the margin, people will, as they sort of get through the inertia of the fleet I talked about earlier, going from 9 years to 12.5 years in the last 20 years or so, will still dictate a sort of measured pace of build out in EVs, but they are better products. Oh, and the Trump, I think you asked for the Trump presidency as well.
Yeah.
We spoke with one of our geopolitical external research providers yesterday that we value quite highly. Interestingly, they switched their chance of a Trump presidency from 45 to 55% just last week. Biden was went the opposite direction, 55 to 45%. I guess what's interesting is not necessarily who wins, but what we think the path forward is, irrespective of which candidate wins. I think the first thing to observe is it's a second term for both presidents, and oftentimes that second term is often a lame duck sitting, so it's quite hard to make big sweeping changes. The other thing that's notable, certainly when I was in Texas last month, is that a lot of the beneficiaries of the Inflation Reduction Act are in fact quote-unquote red states. So it's kind of, it seems unlikely, we think, that a lot of that stuff might get rolled back and all of a sudden renewables goes out of favour and it's back to all the traditional stuff. What we can observe, I think, is that we would anticipate a continued sort of, at the margin, isolationist policy approach from either candidate, and maybe slightly more so if Trump were to get in. The key question actually would be what happens to Europe and all of that, because Trump has been quite clear and obviously caveat emptor has been clear on lots of things and perhaps change his mind once he's got there, but that he would look to remove the United States from Ukraine, and that could have very lasting effects in Europe. Because frankly, without the support of the United States from a military perspective, I think we've struggled to sort of maintain the line that we have done in Ukraine so far. So probably more protectionist. I think that the sort of natural lead on from that is, what about China? It's definitely the one area where there's broad agreement from either the blue or the red side in Washington DC, and that there's a concern around China, that tensions will remain relatively high. But actually, if you observe what's happened in around Ukraine, Russia, for example, or even in the Middle East, both of those events could really have catapulted a real détente between the two superpowers. But actually, both have remained relatively pragmatic, which we hope will continue to be the case, because ultimately we don't believe the policymakers on either side really want a full-on confrontation anytime soon, and fingers crossed that remains the case. But certainly the upping the ante on tariffs we think will continue, and all of that pulled together frankly means that energy transition is playing out to be more inflationary, with higher upside risks to sort of inflationary spikes as we look ahead.
Great, we've got quite a few more questions to get through. We'll do our best. So, question on valuations. So you've given a lot of compelling reasons for investing, but in all three areas there's a lot of negativity around, whether that be the worry about a downturn in the economy, deglobalization, whether that be concerns about ESG. What do you think? What key factors or events could lead to a shift in valuations?
Probably the easiest ones, but tech stocks to stop going parabolic. Joking aside, actually, I guess the easy thing to have done last year would have been to own, the Magnificent Seven in the S&P 500 and not bother with anything else. But actually, when we look at the traditional sectors first, I mean, if you take just the example of the energy stocks, when we look at the capital that's been put into, if you kind of pocket things out, let's think about the ESG angle first. There will always be a subset of investors that really don't feel comfortable investing in some of the more traditional companies. We completely understand that. But as we look at the world, we believe that they have actually a really important role to play in the build-out of renewables at a reasonable pace, the continued decarbonisation of the existing traditional hydrocarbons over time, and still helping to meet the current energy demands of the world. Because frankly, if we stop producing natural gas tomorrow, then there's no ammonia market, there's no fertilizers, and lo and behold, we can't feed 8 billion people. So we feel from an ESG perspective that a lot of the companies are leaning in a sensible fashion, a pragmatic fashion, into the energy transition. What's interesting to us, though, is what we would deem to be the mispricing of a lot of these more traditional assets. So, the bigger energy companies trading on mid-teens free cash yields. It means you get all your money back in 6 years, and then you just have to assume there's a terminal value of zero. We don't believe that's the case. We think there is a multi-decadal role for a lot of these companies to play. Some will not survive through the energy transition, but certainly the bigger companies have got some pretty decent prospects ahead of them. So we think fundamentally that it's not going to be sort of a doubling from here as we got from the lows in COVID, but a nice steady grind where you can actually start to foreshadow, sort of very, very low single-digit top-line growth from the traditional hydrocarbons business to mid-single-digit growth from the emerging low-carbon business, and all of a sudden you don't have a company that's ex-growth anymore, that's actually delivering reasonable returns and critically returning a lot of cash to shareholders. So I actually feel pretty good about it. It's certainly not focused on AI directly, but actually on that piece, we think that, say, a lot of the traditional boring utilities are beginning to look, incredibly exciting now, believe it or not, because, when we start to look at the electrification of the world's energy system, you start to look at AI demand, particularly in the US, is likely to go from sort of 1% of current energy consumption to 5% or more. And a lot of these chips are incredibly energy intensive once they're up and running. say that the likes of the big chip manufacturers have announced in recent weeks and months. So the valuations in a lot of these traditional power companies, for instance, are now at multi-year lows and beginning to look very attractive, especially when you juxtapose that with what's been effectively zero growth in electricity demand, particularly in developed markets, for decades. And now we can paint a reasonable picture of, let's say, low to mid-single digit growth. Doesn't sound very much, but compound that with 30 years, it's a very different value proposition than we've had in the past. I think the area where we're probably still a little bit reluctant to sort of go all in, as it were, is on some of the more newer energy technologies, whether it's solar, whether it's wind, whether it's on hydrogen, electric vehicles. Again, going back to that chart, which sort of espoused that 2023 was a banner year. You purely measured it in terms of volumetric growth, but price growth didn't match it. And unfortunately, a lot of the stocks have done very, very poorly over the last 12 to 18 months. But again, the valuations are beginning to look a lot better. What we're hoping to see is a sort of amelioration in the interest rate environment, because the high growth companies that do require quite a bit of external financing. We'd like to see an amelioration in supply chains, where we've seen a lot of oversupply in the solar value chain, for instance. And then you can start to see a path towards inflecting the margins back into positive territory, where they've been dreadful for the last 18 to 24 months.
On EV sales, now that we're on this slide, you mentioned the strong growth we saw this year, but has this growth peaked? Should we expect demand to fall? Clearly, there's been a mismatch between expectations and sales, at least in the short term.
Yeah, no, completely right, Tom. We still think there's pretty healthy sort of sales growth over the next 2, 3, 4 years, even in a sort of reasonably short time frame. The problem we've got is that there's a price war ongoing right now. So from an equity perspective, we'd still expect ultimately earnings to be negatively revised in the next sort of 6 to 12 months. But as we sort of get past this oversupply period, as we've seen, then we fully expect that a sort of a moderated resumption in EV sales growth out to the end of the decade and in fact beyond. So now we're not particularly hot and sweaty about the EV space today, purely from an equity standpoint. But the sort of multi-decadal growth hasn't changed. It's just that we have a period of oversupply right now that we do expect will get soaked up, because people are price sensitive, and if they can buy an electric vehicle at an attractive price, then they will.
How are you for time, Mark? Are you okay to do a couple more questions, or you need to?
Delighted to, yeah.
Great. So renewable energy companies, obviously in our space, we look at them a lot. And we have a question about the wide discounts that they trade at. I know you can't talk about specific stocks, but is this a sector that you could or would invest in?
Yes, is the short answer. I think selectively for now is the slightly more nuanced answer. So valuations have come down a lot, but if you look back to say 2020, 21, you can look at the iShares Clean Energy Index, the sort of S&P Global Clean Energy Index, but the iShares equivalent ETF. And from memory, we had at peak, I think they were trading at like 50 to 60 times forward year earnings. So it's 50 to 60 years to get your money back. A lot of the stocks in there, to be clear though, are sort of very heavily weighted towards solar companies. But it was clear to us that the valuations were just in nosebleed territory. Where we are today, you're kind of in that sort of mid-20s to high 20s PE range in the aggregate for that universe. And frankly, if you can buy some of the tech stocks, the Magnificent Seven, an optically lower multiple than that, then perhaps now is not quite the time to be leaning in. We'd like to see a little bit more headspace between those valuations, not necessarily copying them against the tech stocks, but just observing that those are businesses that generate free cash flow with growth, whereas a lot of the renewable energy companies are still to hit that free cash flow nirvana yet. So we would like to see the multiples come back a little bit further before we sort of lean in. But when we look at the outcome of policy changes, we've seen forecasts get revised progressively upwards. The big roadblock, though, the thing that we're somewhat cautious of, is that even in the event that the two charts we've got in the middle there look very compelling in terms of that rate of change in forecast and build out of renewables. The problem we've got is not the build out of the supply chain, it's the permitting. Permitting is a nightmare, particularly in Europe, when it can take 3 to 4 years, sometimes longer, to get access to the grid to connect up a new solar farm or a new wind farm. So, although the sort of spreadsheet math would look very compelling as shown here in these two charts in the middle, the reality might still play out to be slightly different in terms of the actual build out of renewables, at least in the next 12 to 24 months. We do need to see an improvement in that permitting process.
And it is battery a key factor in this transition. We saw just today Rishi Sunak declaring that we needed to keep gas stations active for longer to back up renewables. Battery is the other solution floated for this, at least in the abstract. Is that a critical element that we need, this battery storage network to generate the energy transition?
Yeah, I think that there's probably a little bit of a nuance around this one. Certainly when it comes to electric vehicles, absolutely, we believe batteries have got a key role to play there. And actually, when thinking about the power system, we sort of think about the car to grid. So as the EV build-outs continue, you've got that optionality as we have smart grids kicking in, that you can actually feed electricity back into the system. Hopefully the right price incentives and regulatory frameworks are there. We know, for example, that that's been tested now several times in California, for example, with Pacific Gas and Electricity, the incumbent utility there, where they've actually got an app that they'll go and sort of put a price out and keep putting a fresh price out until people bid their EV storage back into the market. So certainly there's a role for batteries to play in that dimension. As it relates to sort of utility scale storage, we're still a little bit more sceptical because although the battery prices have come down fantastically quickly in the last decade or so, when you're sort of strapping on these batteries, say, to a solar farm, because the solar farm might only be running a utilisation of 25%, for example, if you wanted to go like 100% solar in the grid, then you're going to have to build 4 times as much, and that means you have to build 4 times as many batteries. And actually, the more batteries you build, the less you'll be cycling the batteries, and the worse the economics get over time. So the utility scale batteries will probably, again, there's a role to play in the sort of daily intermittency piece, but not so much in the sort of seasonal from summer to winter storage, where you can store natural gas, for example, and salt caverns under the ground. If you've got hydro, you've had a good rainy season and you've got pumped hydro available as well for you. Those are probably the bigger battery storage options, if you like, that we think from a utility scale perspective.
Brilliant. And we did have a question picking up on nuclear energy. So you discussed it in the context of sort of a potential solution for Europe, but more broadly, what do you think is the role nuclear has to play? I mean, that was one potential route out you suggested, but do you think this is a route that's going to be taken? Is nuclear going to form a large part of the supply? It's very noticeable in the chart you showed of the forecast of energy generation over time. It remained a very small sliver. What are your thoughts?
So that if you start from the sort of basic physics principle, and I'm sure most people have read about this already, but and the numbers are never perfect, but very broadly speaking, the energy return on energy invested, how much energy you have to put in, how much energy you get out over the life of that asset, can be 2 to 5 years in, say, solar and offshore wind. If you look at nuclear, it's from the moment you turn it on, both for solar, wind, and for nuclear, it's 6 weeks. 6 weeks you've got the energy. That's how energy dense nuclear is. So, from a pure physics standpoint, it absolutely has to play a role, we think, because you can run 90% plus utilisation on these assets, whereas you might be, if you're lucky, 25% for solar, but if you're in Germany, it might be 10%. And wind can be very erratic as well. The obvious other observation would be around solar and wind is that, of course, you can build more to sort of fill out that capacity gap, but it's DC to AC, and it's got a lot of a different sort of frequency signature to the nuclear. It makes it harder to fit it onto the grid. So we are advocates of nuclear. I think the challenge for us, though, is, again, it's the permitting side of it. And if you look at, say, Hinkley Point C, I was looking at some of the numbers the other day, and it's staggering when you think of it. And there's lots of reasons why it's ended up being as it is, but the Hinkley Point C nuclear reactor that's been built by EDF and the Chinese, it's gone from, I think, £16 billion estimate to £44 billion estimate, and it's probably going to be about 5 years late, plus or minus. Now, to be fair, there were all sorts of difficulties that went on, say, as they were planning and permitting. Fukushima happened, so the regulator wanted to go back and make sure everything had been properly spec'd from a safety perspective. But still, those are staggering numbers. And when, it's funny, I was coming in on the tube to work yesterday morning on the Waterloo City line, and I saw a big advert for the government advertising for people to go back and study nuclear engineering. Which is fantastic, but it underlines a really key point that we've completely de-skilled in terms of that engineering capability. And I always think that the sort of glaring example of that is that, the British invented railways, and now we can't even get the high-speed rail link right either. Again, the costs have gone from like £30 billion to £90 billion. So if we can't build railways and we invented them, what chance have we got to do nuclear? So there's going to have to be a reskilling. And we may have to think tactically about, who we choose to build nuclear reactors, and certainly certainly some of the Asian countries, South Korea, for instance, have a really good proven track record at building nuclear facilities in a timely and cost-effective fashion. And if we can get the timely, cost-effective piece right, then it starts to make nuclear look more competitive, and it can come in at the right speed to help support the renewables. But right now, we could easily be looking at sort of 10, 15, 20 years, and that's why you're not really seeing that green slug at the top expanding at sort of any reasonable pace.
Yeah, I think maybe the Chinese do have plenty of nuclear-trained engineers, though.
Oh, they do, but I guess it's to be a geopolitical concern there from the British government as to you might choose to have the build of nuclear reactors, but that's
absolutely, yeah.
My take, I'm afraid.
Yeah. But great. Well, I think I'll try and sneak in a final question. Thank you very much for being so generous with your time. On interest rates, so there's a chance of a cutting cycle starting later this year. What impact would you expect that to have on the portfolio?
I think, as I said already, part of the sort of, if you like, the checklist that we'd like to see come, nothing's ever perfect in the world of investing, of course, in order to get more constructive on the sort of more interest rate sensitive companies. So think utilities, think any of the high growth solar and wind companies that lean heavily on project financing. That would clearly be beneficial for them to start to see that interest rate cycle roll over. I think that would be the most obvious area where you'll likely see some change if it were to play at a reasonable pace. But I think the blocker in that instance, certainly from the renewables piece, and certainly within Europe, is the permitting still really slow. So probably the sort of utilities power space first, then some of the growthier names second, if the inflation cycle is sort of coming to an end and we see those cuts come through.
Brilliant. Well, thank you very much, Mark, for the presentation and for answering so many questions. And thank you to everyone in the floor for all those questions. Hopefully we'll see you on Friday, where we'll be taking it. We'll be looking at the prospects for India. But Mark, thanks very much. Very interesting presentation. And have a good day.
No worries.
Bye bye.
Thank you.